Hi there, selling through Amazon or eBay? Let's examine how UK VAT can apply to marketplace sales during 2026-27.
Imagine opening a letter from HMRC and finding a retroactive tax bill that wipes out your entire year of profit. This happens to online sellers who misinterpret a single legal definition, who the actual supplier is in the eyes of the law. I'm your host, and here at Atlas Tax Advisors, we specialize in helping businesses navigate complex HMRC regulations so you can focus on growth without looking over your shoulder. The rules we are looking at today apply to a very specific group. This is for UK-established businesses that hold physical stock in UK warehouses, including Amazon FBA, and sell to consumers through platforms like Amazon and eBay. The UK VAT landscape is currently facing its largest overhaul since 2021. Upcoming government proposals are targeting the exact legal definitions that determine who is liable for the tax on every sale you make. Operating under the radar is no longer an option. Securing your business means clearly defining your exact legal relationship with the marketplace before the rules change. Looking at this flowchart of current VAT rules, you can see how the system sorts sellers into two distinct categories. If you are an overseas business, or if you import goods worth £135 or less, Amazon and eBay operate under the deemed supplier rule. They collect the VAT from the customer and send it directly to HMRC. But if you are an established UK business holding physical stock inside the UK, the marketplace acts strictly as a payment processor. They facilitate the transaction, but the legal responsibility to track, report, and pay that VAT falls squarely on you. That domestic liability requires you to track your rolling 12-month gross sales against the UK VAT registration threshold, which is currently set at £90,000. And you have to measure that by combining your sales across every single platform you sell on. Some sellers attempt to avoid crossing this threshold through a practice called disaggregation. They split their sales across multiple marketplace accounts, or list under different company names, to keep each account's turnover artificially low. Even for businesses trying to play by the rules, there is a massive accounting trap waiting for them, reporting their net platform disbursements instead of their gross sales. When a customer buys your product, the marketplace processes the full payment. Before they transfer that cash, they automatically deduct their commissions, shipping fees, and advertising costs. If you use that final lower payout figure as your official turnover for HMRC, you are underreporting your gross sales. Doing this consistently hides your true output VAT, quietly building up a severe tax liability over time. Misidentifying your role as the legal supplier and using net payouts inflates your perceived profit margins. The business looks healthy on paper, right up until HMRC conducts an audit and demands the missing tax. Those reporting errors used to be difficult for tax authorities to catch. That changed in January 2024 with the introduction of the Digital Platform Information, or DPI, rules. Under DPI regulations, online marketplaces must send detailed automated reports of your trading activity directly to HMRC every year. Tax inspectors now use this exact data feed to cross-reference the numbers on your self-assessment or VAT return. They can instantly spot if you've reported a net payout instead of a gross sale, or if you've been disaggregating accounts. But HMRC is taking it a step further. In their latest consultation for the 2026 and 2027 tax years, the government proposed extending the deemed supplier rule so that it captures domestic UK sellers as well. This checkout flow visualization shows exactly how that proposal works. If enacted, Amazon and eBay would collect the 20% VAT at checkout on behalf of the UK seller. That 20% is routed directly to HMRC, completely removing the seller from the collection process. The government is currently debating a minimum platform threshold for this rule. They might apply it only to businesses selling over £90,000 per platform, or they may set the threshold much lower to catch fragmented sellers right from their first sale. These 2026 reforms show a clear regulatory strategy. HMRC is moving to eliminate seller-level evasion by automating tax collection directly at the source. If platforms begin carving out 20% at the point of sale, the financial reality will be harsh for unregistered businesses. Those relying on threshold avoidance to maintain their profit margins will face an immediate, severe cash flow squeeze. This ties directly into the strict requirements of making tax digital, which mandates the use of unbroken digital links in your e-commerce bookkeeping. Manually copying and pasting your Amazon sales data into an Excel spreadsheet is illegal under these rules. You are required to use API-linked accounting software to ensure your sales data flows securely from the platform to your ledger. Your first step today is to review your rolling 12-month gross turnover. You need to determine your gross sales across every single channel to determine exactly where you sit relative to the £90,000 threshold. Next, you must stress test your pricing strategy. Calculate what happens to your net profit if the marketplace automatically deducts 20% of your top-line revenue for VAT, and adjust your business model accordingly. As we approach 2026, the e-commerce environment will exclusively reward sellers with impeccable digital records, and it will penalize those relying on outdated, manual accounting methods. Please remember that this video provides general guidance. Tax law is highly specific to individual circumstances, so you should always seek professional advice before making financial decisions for your business. If you need help reviewing your marketplace VAT position or preparing your business for these upcoming changes, reach out to Atlas Tax Advisors today. Call us at 07404 427 275 or email info@atlastax.co.uk.